Now, here's what I think is probably the biggest stock story of the day. Netflix surging. That is a 5.5% increase right from the get-go. Why? Because they're going to raise prices 13 to 18%. That is the biggest increase since they launched the streaming service 12 years ago. Netflix zooming as we speak. I need help. Mike Murphy, D.R. Barton, Liz McDonald, Susan Lee, all of us together. Let's start with Netflix.
Let's do it.
Go.
Yeah. So this is a roughly 15% increase in revenue, assuming no one leaves the service, Stuart, because no one would actually leave Netflix. But if they,
I did.
Assuming they don't, that's a 15% increase in revenue. Now put a multiple on that because, again, Netflix is a high multiple stock.
Yep.
This could give it legs, a huge runway on the stock from these levels.
Goldman Sachs just came out, a headline just crossing, that they expect Netflix to beat well above consensus on Friday. So we're expecting, what, 7.6 million subscriber adds. They said that they can come out well ahead of that. So the stock is running today, should be running for a while.
This is, sorry, go ahead,
Yeah,
DR, go ahead.
No, I think the thing is that Netflix is winning the game. They're beating Hollywood at their own game of making better content, getting it to market faster, and people are responding to that by subscribing and continuing to subscribe and saying 13% more, I'll pay that, no worries.
But before we do that, look, nobody, as you say, or very few people cut Netflix. They don't drop Netflix.
No, they don't.
And they won't drop Netflix just because there's a 13 to 18% price.
But let me put my corporate accounting geek hat on, because I used to cover at the Wall Street Journal. Netflix is technically insolvent. Its all-in debt, including its off-balance sheet debt, is running about 5 times its shareholder equity. Remember, companies do go belly up when that wipes out their shareholder equity. So this is a play for Netflix, is to raise those prices, go into the corporate bond market, do more debt issuance, and can they keep this game going? Netflix is a momentum play, I would say.
It could be the technology stock of the year, just like Apple and Microsoft and Amazon have been the technology stocks of
Got a lot
years.
of competition, though.
It's going strong today, 5.25% on the upside.
Yeah.
As you said, no, wait a second, you were right. Speaking of the competition, Netflix will have competition, a lot of it. NBC is going to offer a streaming service. Who else is doing this year? I mean,
well,
Verizon.
Amazon's been doing it. Apple's going to do it more. Verizon's getting into it. So
Disney
right, coming out this
right.
year. So there's a ton of competition there. But I think what's happening, Stuart, you know, we heard all about cord cutting and people aren't going to have cable boxes anymore. Well, now I think what's going to be replacing that is you're going to have your Netflix because of their original content. You're going to have your Disney streaming because of their content. So the consumer is still going to be paying for this. But to talk dollars and cents on Netflix, if your credit card is being charged $11 a month, or if it was, now it'll be getting charged roughly $13 a month. I think a lot of people will look right past that and keep Netflix.
Yeah, and to your point, it's a great point.
Right.
You know, people may say, oh, this is just one more account to manage. You know, NBC is being smart. They're going to debut it around the Summer Olympics. Also, it's free for cable customers, I think $12 a month for a la carte. And they're testing and driving a new long-form ad content. We're 3 to 5 minutes an hour of advertising versus Hulu's, what, 3 commercial breaks, right?
Commercial breaks. And this is, Liz, it's a weak offering that NBC's put out. It didn't make me bat an eye when I looked, should Netflix be worried? It's not that strong. It's ad content, and it's not very, good stuff.
The play that they're trying to attract is maximizing distribution for more profit, basically.
Okay.